Welcome, ladies and gentlemen. We are still in London here now at the offices of Caledonia Mining. And with me here is Mark Learmonth, the CFO of the company. And of course, we want to get an update. Mark?
Good
Hi.
afternoon. Good
Hope
afternoon.
you're fine.
Hi. Well, welcome to our humble offices.
Yeah, it's perfect. No, I like that. It's very straight to the point here.
We keep the cost base down.
Exactly.
Yeah.
That's what you like as shareholders. Zimbabwe. We heard a lot of stuff in the media. A lot of things were coming up. There were like no dollars. Nothing was, no money out of the country. There were hassles in the banking system. Maybe you can comment a little bit on that and if Caledonia was hurt badly or if things are now back to normal. What is the situation?
Okay, it was all very difficult in October. Let's just back up a bit. This may be a very long explanation, but I think people need to understand what's happening there. Until the 1st of October, there was only one sort of bank account that we used to use in Zimbabwe, and that was called an RTGS bank account. Okay, so we sold our gold to the government. They paid us for the gold. We used that RTGS money to pay our taxes, our workers, our electricity bills, our local suppliers, and then we had to apply to the government to get money from that RTGS account to externalize it, to pay for your fees, to pay for cyanide, to pay for all that sort of stuff. And I've said this to you before. It was hard work. And it required constant attention, but we made it work. Okay, so that's what happened until the end of September. In October, the government, actually with the best of intentions, changed that system a bit. So what they did is they effectively bifurcated or split the banking system in two, and they still had those old RTGS bank accounts, but they created something new called an FCA account, foreign currency account, which was backed by apparently $500 million worth of funding, and those FCA bank accounts were used by people like ours who export. And so what the government said is that when they paid us for the gold, 70% of our money would go into the old RTGS account, and 30% would go into the FCA account. And now, having split this banking system, that meant everybody in Zimbabwe wanted FCA money. Nobody wanted this RTGS money. And so all those people who'd quite happily been providing us services and goods through the RTGS payment network, where a dollar externally was the same as a dollar in the RTGS system, suddenly they were wanting sort of $5 for the same thing in RTGS money. And it got to the point where in mid-October, Steve Curtis, the chief executive, and I were leaving Harare Airport. We had a ham and cheese toasted sandwich at the airport, $26 each. $26 each.
It's more expensive than in Zurich.
It's more expensive even than Zurich, and it wasn't anything like as nice as Zurich. So what it does, it caused very rapid RTGS denominated price inflation. And at the same time, because the Zimbabwe government ran out of money for various other reasons, they weren't importing diesel, so there were huge queues, 4-5 kilometer queues for diesel. And in October, because of the hiatus as the government was putting this system in place, it meant that during the course of October, we were very, very, very severely constrained in our ability to extract cash from Zimbabwe and use it to purchase the things we need, cyanide, explosives, all that sort of stuff. Now, had that situation arisen, say, 2 years ago, under the previous government, that would probably have been the end of it. Zimbabwe would have closed down and we'd have turned the lights out and we wouldn't be sitting here now. The critical thing that happened in October with the new government is that they opened the doors and they spoke to the mining houses like ourselves. So we had direct contact with the government from the president down through the governor of the Reserve Bank, the Minister of Mines, the Minister of Finance.
So everybody was involved.
Everybody was involved. So we had constructive discussions with them. We also had constructive discussions indirectly through the Chamber of Mines. And as a result of that process, the government understood the problem and took steps to make it better. And so what they did is now they've changed the foreign currency allocation to 55%. So currently we get 55% of our sale proceeds in US dollars, and the other 45 goes into local currency. That's actually more than we used to get when we had to do these sort of informal applications. And the door is always open through the Reserve Bank for companies like ourselves to go and ask for more foreign exchange. So October and the first early part of November was a big hiatus, and I hope I've explained properly what was going on. But we seem to have got our way through this now, things do seem to be stabilising. But the critical thing you've got to understand is the way the government reacted to a problem was very, very different from the way they might have reacted certainly 18
So
months
that was
ago.
in a positive sense
Very
now.
positive.
So they
very
listened to you, they understand.
listened, they understood the
Oh, that's
problem,
super.
and they didn't hope that just by shouting at it, the problem would go away.
Yeah,
which probably would
exactly.
happen. So, it would have been nicer if it hadn't have happened, but I think it's another way of demonstrating that actually you've got a government that you can talk to here.
So you have a fresh wind.
A fresh wind.
That's important. Super. Okay, let's come to the business because that's also very important. How was Q3?
Well, Q3, we put our Q3 results out 2 weeks ago now. That seems like an awful long time. We'd provided production guidance early in the first couple of days of October, let's be frank, production in Q3 and for the year so far anyway, has been somewhat less good than we'd expected. And so in early October, we revised our guidance down to in the low 50s. I think that's sort of 53 to 54, 55,000 ounces of gold for the year. We're very much on track for doing that. And the results that we put out in Q3 were entirely compatible and consistent with that slightly lower production guidance. So we're still on track to do about 140 to 150 cents per share earnings for the year, which is better than last year. And what's also pleasing to note, the thing that I took out of this, is that in Q2, our results were quite badly affected by some fairly unusual adverse working capital movements. Just temporarily, a lot of cash was being locked up in payments that were due to us from government. That actually reversed quite quickly early in Q3. So we began with the working capital situation normalized in Q3, and that's the most positive thing, because critically for this business, it needs to generate lots of cash. So we generate $6 or $7 million a quarter. We're spending a lot as we continue to invest in the central shaft. But after a bit of a blip in terms of working capital and cash generation in Q2, Q3 we're actually back on track. And Q4, I know you're going to ask about outlook. Q4 is actually looking like a very good quarter indeed in terms of production. Okay. As we sort of some of the measures we've taken to deal with, particularly the low grade. The reason why production was badly affected was the grade was somewhat low because of mining dilution. We seem to have addressed that now.
Fantastic. What is the cost side? What does it look like?
Costs for Q3 was the on-mine cost was $670 an ounce. That's gone up very slightly. We have seen it's gone up from about sort of 650, I think, from the previous quarter.
But that's not too much.
And that's gone up because we have seen some of our input costs going up. Explosives seems to have gone up a bit. Cyanide seems to have gone up a bit. Steel seems to have gone up a bit. But at the all-in sustaining cost, that had come down. That's come down. We're now about $750 an ounce. And we expect to stay at that level.
So still a good margin at those.
It's great margin. Great margin.
Yeah,
now this business makes a lot of money, and as we've said many times before, for the time being, for the rest of this year and the rest of next year, we're going to continue to spend a lot of money. But as that spending comes to an end, that capex falls. The production goes up, the costs come down, we'll have this wall of cash, which I know you're looking forward to.
Absolutely, because of the dividend rise.
Because of the dividend, yeah.
Question, how deep is the central shaft now?
The central shaft is now down to about 1,150 meters.
And to what maximum you want to go down?
We've changed the plan there, because one of the difficulties we've had in the course of this year is the incidence of power outages. Now, these aren't. Let's be clear about this. These aren't power cuts. These aren't sort of an hour with no electricity. What happens is that the incoming electricity supply from the grid is very unstable, and it will mean in the course of a night, it might cause our equipment to trip, 6 or 7 times. Just a little blip in the incoming power causes all the equipment to trip. And then it takes half an hour to get it back up and running again. So you can't run the generators, because it's not as though you'd have to run the generators all the time. And the generators are incredibly expensive. Our grid power's 12.8 cents a kilowatt hour, generators 35, 40, 45 cents. And so we just can't run the generators full time. So those power interruptions have interrupted the rate of sinking. We have no choice. We have to get this central shaft running and commissioned by the end of 2020, early 2021. If we don't do that, we will not be able to efficiently access deeper level resources, and we'll run out of material above 750. So it's not an optional extra. We have to get that shaft done. So to make sure we can get the shaft completed on time, we initially were going to go down 2 new levels. We're going to go down from 750 meters to about 1,080 meters. Then about this time last year, we actually decided to sink it 2 further levels below that to about 1350 meters. I think 1330 actually.
Yeah, approximately.
But given the fact that we've now had these sort of delays due to electricity, we've scaled that back a bit. So now instead of going down 4 new levels, we're going down 3 new levels. The target, I think, is about 1250. We've only got about 80, 90 meters to go. We're now busy doing the cross cuts. And so the central shaft is on target to be completed as scheduled. And then we will use a decline in due course. And that's sort of 5-6 years out. It's by no means immediate to do the development down to that 4th level, which we're not going down to. So that's all on track. Absolutely on track.
Fantastic. So how much money you intend then to spend again next year?
Next year we'll be spending at the mine. At the mine we'll be spending about $25 million. There is some internal markup on that. So the consolidated level is a bit less than that. Because obviously all the equipment that we procure or we buy in South Africa, we then sell that up to the mine, and there is a transfer pricing margin on that, but nothing that would nothing that would get the tax authorities too excited. So at the mine level, it's about 25. On a consolidated level, it's probably closer to 20.
Okay.
So still very significant spending, eh?
Yeah, but you generate enough cash to do that.
We're generating $6-7 million a quarter, so plenty of surplus cash there.
How much money is now in the bank?
We've got about $6 million in the bank.
So you have a buffer.
And again, that did tick up a little bit in the course of quarter 2, and it's actually ticked up a little bit in October as well. So the cash generation is fine.
Great.
And as you know, as a Schwabian, you're better at cash management than I am. We watch the pennies.
I love that. Yeah, absolutely. That's great. And you maintain the dividend, of course, right?
Absolutely. Continue to
Quarterly payout.
Absolutely.
So I still can be happy every quarter.
Yep, absolutely.
Fantastic.
Yep.
Great. Mark, thank you very much. Good insight. And I'm very glad to hear that in Zimbabwe things are going now a much, much better way.
Good. Well, thank you very much, Jochen.
Thank you. Yeah, ladies and gentlemen, there was Mark Learmonth, the CFO of Caledonia Mining, and you heard it. The things have, thank God, have cleared up in Zimbabwe. So things are really moving very positively. And it's quite interesting because sometimes when bad things happen, first of all, you are like, very negative on the one side. But on the other hand, when I hear now that the government is listening, the National Bank is listening, so everybody's listening to the people who, want to solve the problems immediately. And they say, okay, we got to learn something here. That's a very, very positive sign for the future. And I think, Zimbabwe is back on track here. That looks much, much better now. Caledonia is really on the path to go by 2021 with the expansion to be finished and to have, finished then the large investment plan, generating over $6 to $7 million per quarter. So, and maintaining the quarterly dividend. That's the most important thing. So thanks for watching us. Check out the company. Bye-bye from London.